Hello everyone, welcome back to my channel where I speak about my net worth and track my investments. In today's video, I'm going to be speaking to you about the decline of dividend investing over the past year or so. I'm going to be going over why dividend stocks and dividend ETFs have had such a bad year and talk about what things you can do or what things you can plan for, what we can see in the future. So on screen, you see my dividend portfolio, approximately $24,000 in value, and unfortunately, it has not been doing well over the past year, and over the past few months, it has done quite a bit worse than everything else in the market. So my dividend portfolio consists of SCHD, a very common ETF, and JEPI, another very common ETF in the dividend investing world. Now, as I already mentioned, dividend ETFs and dividend stocks are not doing well. We have JP Morgan Equitable Premium Income ETF. It is a high dividend ETF that basically sells covered calls. This is down about 2.1% over the past year. We have another very popular ETF, the Schwab US Dividend Equity ETF, which is down about 9.4% over the past year. And we have another ETF, the Vanguard High Dividend Yield ETF, which is down about 7% over the past year. Now, if we contrast those ETFs, those dividend ETFs, with just the general market, you see that the S&P 500, or at least an ETF that tracks the S&P 500, is up significantly over the past year compared to the dividend ETFs. So as an investor, you wonder, of course, where is this all coming from? Where's the growth coming from? Why is the market up while the dividend ETFs are down? And we easily see that compared to the dividend ETFs, we have a SPDR ETF here that tracks the technology sector. This is up significantly over the past year, over 35%. And this also holds true for the ETF that tracks the NASDAQ, the Invesco QQQ. It's about 32% over the past year. So I think it just goes to show that the growth of the S&P 500 definitely comes from all of these tech companies and not the value companies or the dividend companies. So the big question is, why is this down? And there are probably several factors about why dividend stocks and ETFs are down, but I feel like the main one are Treasury yields. We have the 10-year Treasury yield, which is commonly looked at as the risk-free rate that is giving you 4.6%, let's call it, which is a very solid return, and it hasn't been that high in at least over a decade. Now, as an investor, you're constantly looking for the best return measured against your risk. So as the risk-free rate, it is basically 4.6%. So you're getting 4.6% with a guaranteed return without having to lose your equity if you were to invest in a US 10-year Treasury. Now, keeping that 4.6% in mind, you have to ask yourself as an investor, is it worth it to invest in the Schwab US Dividend Equity ETF that's only going to return you about 3.8%, and you also risk losing your capital over time? And it just so happens to look like investors would much rather pick treasuries over those dividend ETFs. And we basically see as this rises, these ETFs fall. Now, these treasury yields have, of course, greatly impacted my dividend portfolio, as I already mentioned. But my blend portfolio, which has QQQ and another ETF, VIG, which kind of focuses on dividends, but it's more so dividend appreciation instead of yield and distributions. This portfolio has been performing pretty well, of course, because the overall diversification within tech companies and not, of course, dividend stocks entirely. So the question for dividend investors might be, is this going to end anytime soon? And the good thing is that hope is on the horizon. In 2024, things may change, rates may hold steady, or they may also be decreased. So basically, we have the Federal Reserve Chair Jerome Powell making a statement that if it becomes appropriate to tighten policy further, we will not hesitate to do so, indicating that it's not guaranteed that rates will stay the same or go down. He's basically saying that it is definitely possible for another rate increase to happen again. And this article at least says if Fed hikes happen again, it will likely only be once. So they only think it'll happen once. The question is, who knows? They might hold it steady, and that would be good too, or they might hike it more depending on whether or not inflation responds. Fed rate hikes affect pretty much every area of the economy. The cost of financing is higher, so the investors that are in real estate companies may be impacted more adversely. So here's an ETF that basically tracks the overall real estate market, the Vanguard Real Estate Index Fund ETF, and we see over the past year it has performed extremely poorly, about 12% down. And again, going back, this is even worse than the other ETFs that I already showed, JEPI and SCHD, because these companies are debt heavy. And let's see, the utilities sector is also another basic industry that has been affected majorly because utilities is another debt-heavy industry. And of course, as the cost of debt increases, their operating costs will also increase. So that's going to affect any company that holds a lot of debt or needs debt to sustain their operations or to basically build out their business. So kind of going back to when this pain ends, a decline in interest rates is expected to be mild. So we're not going to see a steep decline. So even if these interest rates are decreased, it's not going to be by a lot. So don't expect these dividend companies to go up a lot. But the good thing is that we are expected to see a 1% decline in the federal funds rate by the end of 2024, and that is expected to occur around the second half of the year. Now, unfortunately, the Fed's own projections, they see short-term rates of around 5%, so to the higher end of that toward the end of 2024. So again, don't expect interest rates to go down a lot, and don't expect these dividend companies to shoot up a lot. And the final question is, what should dividend investors do? I can basically tell you what I am doing, and that is buying normally as expected. Of course, I'm a bit younger, so I do allocate a decent amount of funds, at least more to my blend fund over my dividend fund, because I'm at the stage of my life where I can definitely use more growth, while my dividend portfolio doesn't get as much funding, but I'm still not cutting down or cutting it out entirely, because I think over time this will come back with future rate decreases, and we never know what crisis might be on the horizon that will cause the Feds to rapidly reduce rates and thereby causing these ETFs to shoot up a lot. So in my personal view, holding steady is key, and I think most dollar cost average investors, that is people that invest on a constant basis every 2 weeks, will also have the same mentality and not worry about the fluctuations, because they understand that this might just be temporary, and kind of guessing the market which way it's going to go is going to be fruitless, and nobody really knows, not the people that write these news articles, and probably not even the Fed themselves, given that the Federal Reserve Chair is not sure themselves either. Furthermore, the good thing about investing in dividend ETFs or dividend companies, at least companies or ETFs with growing dividends, is that unlike the bonds or notes that you would buy, the U.S. Treasury, these ETFs or companies that grow their dividend will pay you more and more, thereby, of course, decreasing or increasing rather your yield on cost over time. So the payout will be significantly better if you were to buy in a low spot, and then 10 years of growing your dividends will definitely work for you more so than possibly just a US Treasury note that you'll hold for 10 years and get a guaranteed return of about 4.6%. It'll work out a lot better if you are to just invest in your dividend ETF that grows over time, typically. Now, of course, if you're an investor that would rather have that guaranteed payment, I would, of course, go with the guaranteed risk-free reward over these dividend ETFs or dividend companies instead of growing their dividends. But if you're younger, I would definitely consider the growth of the dividends an important factor too. So that's going to be it for today, everyone. Thank you all for watching. If you did enjoy this content or you do like investing content, I do make videos regarding this. So please drop a like if you enjoyed the video and consider subscribing for future updates. In the next video, I am going to be going over my net worth in an update around the 25th or so of this month. And I will also probably go over my investment portfolio. Thank you all and have a great day.